Lesson 11, Dividends. So, at this point, we've gone through that there's some net income coming from a corporation, but what does it do with it? Here's a quick review. Hopefully you can pause the video and answer these questions. What are retained earnings and what are dividends? Well, retained earnings are the accumulation of a corporation's net income since its beginning. So that's probably going to be the largest account that a corporation will ever have, because it's basically keeping track of the income over many years if it's being successful. What are dividends? Well, it's a portion of the net income paid out to shareholders. And whenever a corporation makes money, it has two options. One, to keep the money in the business and continue to grow it. That's the expectation. Or two, if it wants to try and pay it out, it gets paid out as a dividend. Remember that this is not a partnership, so we can't just send it out to the capital account. It goes out as something else. Dividends could be paid as shares or as cash. And sometimes some investors like to have cash flow, and that's why they will look at the dividend yields. So what exactly is a dividend? It's a distribution of a portion of a corporation's retained earnings, typically paid out monthly, annually, or quarterly. So types of dividends could be a cash dividend, which is obviously cash, and the second one could be a stock dividend. Both have different characteristics to them. Some people want to have a cash dividend because they want the cash and they can go spend it wherever they want. The stock dividend could be nice if you want to try and keep your ownership in the company and you wanted to see it grow with it, and you don't have to pay for the actual trade of that transaction. Cash dividend requirements. To issue cash to shareholders and the company issues cash to shareholders, and the company must have enough retained earnings, enough cash to make the actual transfer, and it must declare the dividend. Canada Business Corporations Act, a corporation cannot pay a dividend if it's unable to pay its liabilities. And this is because they're trying to protect those people who have ended up lending money to the corporation, so it doesn't just end up paying a whole bunch of money out to people who are the investors. Bit of an issue with that if you were to try and just start a corporation, borrow a whole bunch of money, and then pay it out, and then you basically just screw over the people who've lent money to the business, and that's the way some fraudulent activities happen. Let's look at analyzing dividends. EPS is a common term which we use in corporations, which stands for earnings per share. If dividends are low, it could indicate two things. One, that the earnings are low for a corporation, or two, that they're trying to retain the earnings in the corporation to grow. And we also have to look and make sure that the EPS is positive. So what does high dividends indicate? Well, it could indicate high earnings. They got more than enough money to deal with, and then they're like, okay, well, I can just pay it out to the shareholders. Perhaps it could indicate that the company is not trying to grow. And here's another one. What if the dividend is greater than the earnings per share? Can that happen? Absolutely. Maybe it didn't have a good quarter. Maybe the company is shrinking. Or maybe there was a correction needed to the dividend. The one thing is, corporations definitely do not want to upset their investors. So if they've said, we're going to pay out a dividend of 7 cents per share, they expect that they're going to follow through so that the investors are happy. Of course, that means that most likely the stock price would go down if the earnings per share is less than the dividend, but that's something that they have to work with. 4 key dates. Well, there's a declaration date, and this is coming from the board of directors. We declare that we have a cash dividend that will be paid on this date and a record date of this. And so, based upon that information from the board of directors, those dates are very important. There's something called the ex-dividend date, or the X date. This is the date at which the shares are traded without a declared dividend. So if you have it on the X date or after, you don't get the dividend. The record date is the date to record ownership of the shares. And there's a payment date is the date that the dividend is actually paid. So usually the declaration date will be about 30 days before. The actual dividends will be before the record date. And the record date is going to be, let's just say it's going to be usually I think the third week of a quarter, and 2 days before that is what we call the X date. And this is because 3 days before it it takes 3 days usually for a transaction to go through and change the ownership of shares. So there's something called an ex-dividend date, and then there's a payment date, which is usually about 7 days after the record date, or possibly more. So what is actually journalized? The journalization occurs for the declaration and the payment date. So there's 4 key dates here. Now, just to reinforce this, I don't have the audio that can come through, but I will include this link in the just below the YouTube video. I encourage you at this point to pause and watch this video because it's going to explain that concept of declaration date, ex date, record date, and payment date with a little bit more graphics to support what I'm talking about. And of course, here's some true-false questions to try and test your understanding of it. So you should watch that video, pause, and then try and answer these questions. November 30th, a company declares a dividend of 35 cents per share at the end of the third quarter with a record date of January 16th, 2014, and a payment date of January 30th. True or false? The ex date is January 14th. Well, this should be, let's see here, 2 days before the January 16th, it's 14th, that should be true. If you purchase shares on January 13th, you will still receive a dividend. Yeah, that should be true because it's at least 3 days before this. You got it before the ex date. If you purchase shares on January 14th, you will still receive a dividend. Well, that's the ex date and beyond, so the answer should be false. You won't get a dividend because X means you've basically been X'd off the list. You are no longer a part of the shareholders at that point on the ownership of those shares. You would expect the stock to drop by approximately the dividend amount on January 14th. What do you think? This will be true because at that point the dividend is now trading, the stock is now trading without the expectation of that dividend to be paid out. The moment that the 14th hits, you expect it should drop by about the same amount. You could go off and take a look at stock markets to confirm whether or not this is true, or if there's enough volatility there to maybe make some differences. Of course, natural volatility will also be involved in it as well. It is possible to buy shares just before the record date and then sell those shares off. Yeah, you could do that. Dividends are taxed more favorably than capital gains. This is true. So this is sometimes why you might want to end up buying this just before the record date, or sorry, just before the ex date and get the dividend. It takes 3 days for the exchange of shares to settle. That's true because that's the whole point of the ex date. If you bought shares on the record date, you would still receive a dividend. Well, that's false because on the record date, it won't show up until 3 days after the record date as you owning the shares. So that is false. That's exactly why we have the ex date. So if you got these and you understood what's going on, you're in pretty good shape. Now let's take a look at some journalizations of this stuff. On November 30th, the company declares a cash dividend of 35 cents per common share with a record date of January 16th, 2014. So yeah, this helps us, but we need to know a little bit more. How many shares are there? Well, journalize the entries related to a dividend if the company issued a total of 1 million common shares. This is how many they've actually issued. So how much is that actually going to be as a dividend? Well, it's going to be 1 million times 35 cents. I think that works out to $350,000. At this point, I'd encourage you to pause the video and think about what are we going to be debiting? What are we going to be crediting? Try and relate this back to how you would have dealt with the same situation in a partnership. What would you be debiting? Well, on the record date, we have that we're saying we're going to pay some money. So we're going to have a payable account. And, well, what do we end up? Well, that's going to be a credit. So what are we going to debit? And so now we introduce a new account called cash dividends. And we put in this little dash for common because there's different types of shares. Common shares are preferred shares. There could be type A, type B shares. And our calculation was correct that we had 35 cents times 1 million is 350,000. And then we have a second date. What's the second date going to be? Again, I encourage you to pause and think about what's going to happen here. We're going to be reversing what we did. So we're going to have dividends payable is going to be off the books. So we're going to be debiting that and we're paying it out. So it's going to be bank will be credited. And the date, well, the date's going to be January 30th. that ends this lesson on dividends. I hope you've enjoyed. There's a little bit of reading for you to go through, and also some questions about what is the purpose of retained earnings and why might they want to retain them and maybe have a negative balance. And if you've been paying attention to some of the things I said at the beginning of the video, you'll already know what the answers are. Enjoy for now.